Will a strong economy drive higher profits? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Andy Constan, CEO and CIO of Damped Spring Advisors. Hi, Andy.
Hey, Maggie. Good to see you again.
Good to see you too. We are finishing up another week, which was action packed. Really, we had stocks closing out a fifth straight week of gains. Some big banks kicking off earnings season. J.P. Morgan Chase and Wells Fargo both topped expectations that seemed to lift the mood. But we've had another PPI reading in a string of really interesting data. So let's just start off with your sort of high level view. When you look across all that we're learning about the economy and all the market action and reaction we've seen, what's top of mind for you? How are you
Listen,
feeling about things?
so for me, I'm focused mostly on the bond market right now. There's been major moves in the bond market. Through the summertime, we had a economy that people expected to cool quite aggressively. Job market seemed to be cooling. We got a couple of weak job reports, and disinflation, which has been going on forever, had kept going toward target. So the Fed decided to cut 50 basis points on the FOMC meeting. And since then, the market reaction has been very interesting, and the data has been even more so. And so the way I think about the Fed's reaction function is they tell us what it is. They tell us in the dot plot. And the dot plot basically said, we're cutting 50 today. We're going to cut 25 two more times. And the market immediately took that to mean they're cutting 52 more times and priced in 82 basis points of cuts at peak soon after the meeting.
Mm.
And equities didn't really do much. They basically stuck in a range until this week, rising, but stuck in a fairly tight range. But what happened immediately after that is, firstly, all the Fed officials came out dovish, and Waller talking about the idea of having a long way to cut and worried about disinflation that goes below target.
Mm.
And Goolsbee, being Goolsbee, was also thinking that a lot of cuts have to happen. And so that got priced in. At one point, trough cut expectations were for 225 basis points of cuts on top of the 50 they'd already done, taking rates below 3% at trough. And from my point of view, the short rate, this Fed funds rate, has very little connection to the economy anymore. And what really matters is, what really matters is the
Don't worry about it. I
is
would kid you that it's a Fed official dinging
is
you
the
to
right
proceed with caution.
is the asset market, which to me is extremely easy. Gold is responding to very easy conditions.
Mm.
And the easing went even further because short-term rates produced that outcome where they had 250s priced in practically and 225 to trough. And when I think about the Taylor rule, which is the reaction function that they type out when they do the SEP, they have, it's really three legs of a stool. Each leg is GDP, how that's going to come in. They predict a 2% GDP in the most recent report, 4.4% core PCE, unemployment rate, which they penciled in, and a 2.6 core PCE. And since then, since all that dovishness, some very important data came out. Late in September, the GDI, which is the mirror image of GDP, gross domestic income versus gross domestic product, and they should be the same, had for a long time been worrying a lot of people about the persistent strength of the GDP, given that the GDI had led much lower and there was a huge gap between the two, which indicates The consumers tapped out, spending is lower, incomes are lower. Um, and that got revised right at the end of September significantly so that they are now spot on. And immediately at NABE, when Powell last spoke publicly, he said that that was a very important factor in terms of eliminating a risk to the downside for the economy.
Mm.
So GDP, which they had projected at 2%, is currently printing at 3.2%, no longer has much downside and is well above their target. So
Mm.
one leg's knocked out of the stool. The second leg was the non-farm payroll report that we got early in October, and that was just fantastic across every metric. And the unemployment rate, which is the input to the Taylor rule, was 4.05 versus their 4.4 target. So now you have a unemployment rate with only two more unemployment um, data before the December meeting when they were supposed to have cut 25 twice. Um, well below target,
Mm.
well below, much healthier. And so all of that rhetoric about the weak economy, the weak, and in particular their concern and move toward the jobs mandate, that leg got kicked out. And then CPI and PPI today, the last 2 days, essentially kicked the third leg out with a hot CPI, a PPI that was in line, but the components that make up the core PCE were stronger. And so they probably make their 2.6 target, but you're going to have to get in these next two series of inflation data, you're going to have to get some serious cool prints relative to expectations. So they may not make that target. So if they're 3 for 3 not making the target, the market has to begin thinking that one of those 25s may not even happen. And that's what happened in the market over the last 2 weeks, 3 weeks or so.
The
We thought,
realization, that's what we saw in Treasuries, the realization that, hang on a second, this scenario that was painted and that we all embraced after the FOMC meeting is on very, very shaky ground right now.
right, exactly. And so, for instance, there's a 17% chance of a November pause now priced into the market versus there being a 90% chance of 50
Mm.
soon after the meeting. So that is a huge reversal. 2-year notes sold off 50 basis points. Interestingly, so did 10s and 30s. They sold off 45-ish basis points. So it was a parallel shift. We talk about bear steepenings, bull steepenings, flattenings, and so on. This was mostly parallel, which
Mm.
indicates two things. One, the path of the Fed's cutting cycle is going to be much shallower, less fast,
Mm.
and arrive at a shallower place, meaning rates are the long-term neutral rate is being priced to be higher. Now, what does that mean for the equity market? Well, less unemployment, great GDP, PCE, that's going to be a little on the warm side of target, but nothing crazy, is great for earnings. And so you would think that would be great for equities, but and has been. The strong economic data has been responded by any sort of dip being bought and
Mhm.
closing near at our all-time highs. And so equities have responded to the economic data, and they've done that by basically increasing earnings expectations by the amount that the um, market has gone up a couple of percent,
Mm.
while the multiple, which is already pretty darn high, has not yet responded to the significant increase in both nominal yields and term premiums on bonds. And so that's part of the reason why all this good news was not met with a massive up move. It would
Yeah, so
normally be
it
a massive
sounds like Goldilocks, but the problem is that it's not necessarily gonna translate. It's the sort of rub of higher rates when you're looking at.
right. The question is on valuation, which, my basic framework is, and it's not always true, but my basic idea is if bonds offer a higher return than they used to, That should encourage people to go from equities to bonds. Right now, all the absolute opposite is happening. And so we're in a rate of change thing where bonds are being sold
Mm,
to raise cash. Some of that cash may be drifting into equities because, again, the economy is gangbusters. But at some point, when that shift occurs, then people are going to look at the relative value of those two assets,
mm.
and there'll be some convergence between them, in my view, to lower equities, but maybe not, maybe just to higher bond prices.
Yeah. So it's funny you were talking about stools of the leg because folks on Twitter noticed that you put out a little clip from the Karate Kid saying "sweep the leg," and someone said that sounds ominous. Will you
It's
reveal,
not.
Ethan? Will you reveal your strategy for tackling market uncertainty? Thank you for that, Ethan.
Yeah, yeah. That,
Yeah. What were you talking about? So, like, explain that.
well, I mean, I think the first thing was that back a few months ago, I noticed the very low interest rates, very stimulative financial conditions, robust equity markets, uh, a big move upward in gold, and a Fed that really wanted to cut under pretty much any circumstances and then executed on that goal. And my view was that would make very quick work of the economy. Unlike the long and variable lags of twisting the short-term interest rate,
Mm,
when you get mortgage rates down below, where to the lows they hit, you get um, equity prices up, you get crypto prices up, you get gold prices up, you get the dollar down. That generally results in some stimulative um, behavior in an economy that was already stimulated by already low rates.
mm.
And so that flows through very quickly. And so I'd expect these, no, so I expected these numbers to come in hot. I didn't expect Powell to do 50, but when he did, it was like, get short bonds. And so I got short bonds. And I'm short a little bit of equities in my alpha portfolio. Always long. I'm always long everything in my beta portfolio, but that's sort of irrelevant. We're here about talking about, so I think, about market direction, and I'm a little short equities. I bought some puts in equities that are underwater right now because I do expect that catch down of equities to the bond market after the earnings season plays through,
Mm.
and people look at all of the earnings expectations and the multiples and compare that to bonds. And so I got short bonds. I was a little short equities. That hasn't worked. The bonds have really worked. And as of Thursday, I started covering those bonds. I'm still short. I bought 2 year notes first because they are now priced for only what the Fed has said they're going to do.
Mm.
My guess is that it's unlikely the market's going to say, well, you're saying that we're going to cut too much. The market always seems to want the Fed to cut more and price that way, and
Mm.
has been doing that for since the hiking cycle, even before the hiking cycle ended. So it's going to take till the Fed tells us we're not cutting as much for 2 year notes to fall. So I bought some 2 year notes and short 2 year notes and long 2 year notes and short 30 year notes at this stage,
So
and a little bit of equity.
it's interesting. The timing is tough, right? That's one of the trickiest things. It's interesting because right now, I think you laid out a sort of third scenario. It might what might be, and at the beginning you were talking about stocks and bonds. It sounds like, and correct me if I'm wrong, not being correlated, right? Like if the stocks start to realize, and then you see bonds, is there a situation where bonds, if people are saying, "Oh, well, for relative value, maybe bonds look like I can get a yield in bonds, I'll go there." Is there a scenario where neither of those choices look attractive?
Yeah, I mean, I think that you have to think about assets versus cash, and you have to think about relative assets. And generally, absent any change in the value of assets as a portfolio versus cash, they are good diversifiers. When
Mm,
growth is strong, you buy equities. Equities route, you don't buy them. Equities go up, bonds go down. When growth is weak, bonds go up, equities go down. Right now, we're in a growth is strong. Um, where so that's what generally happens, and that's what is happening. We're seeing bonds sell off and equities rally. So, the average portfolio is doing fine.
Mm.
Um, the time when both go down or both go up, and we've seen both go up through August, um, is when cash is being devalued by the central bank. And for, I don't know, 3, 4 months, the Fed has been telling us I think it's really been since last October. The Fed has been telling us they're going to ease soon.
Mm.
And they got very aggressive in July and then, in fact, eased 50. And, all of the rally of both stocks and bonds and gold and, commodities and everything, the everything rally we saw through the summer was because of the Fed essentially saying, you don't want to hold cash. We're going to cut the rate on that significantly.
Right, pushing it into the financial economy.
Right, right. And so why did they do that? They thought the economy was weakening. What will they do if inflation, as I said, all three of the metrics that they use to cut rates are now going in the opposite direction they were the last 3 to 6 months? Will they decide to cut rates less? If so, you want to own more cash and less assets. And it doesn't matter which assets you own. Now, what are they afraid of? They're afraid of inflation. They are not afraid of a strong labor market unless it is inflationary. They are happy to run the economy hot without inflation. But they told us they were going to cut. They will cut. They told us they were going to cut. The question is how much and how deeply. And right now we're in a period of time where the market is tightening financial conditions. It's raising long-term bond rates. That raises mortgage rates. There's a spread between the two, but that raises mortgage rates just because the long bond is going up in yield. Corporate bond yields are going up. Equities have not gone down. But if equities were to begin to go down, at that point, that would flow through to the real economy and potentially slow it enough so that the Fed would do the cuts that they've promised. But if not, if that tightening of financial conditions doesn't slow the economy, they're going to have to use their levers, which is the short-term rate, and cut less than they've told us they're going to.
Yeah. Can they run the economy hotter without sparking inflation?
So that's interesting. Most of my career, they've been able to do that. And the reason they've been able to do that is because the job market could get very, very tight. Now, they made a couple mistakes when this happened and actually hiked, and it didn't really matter. This like 94 and even later. The economy globally has benefited from disinflationary pressures of globalization. And for 40 years, you could run the economy hot because any inflationary impulse that and any fiscal spending that was done would create was offset by cheap labor everywhere else other than the places that consume. And will that continue? It seems like we're going in the opposite direction on that. One of the benefits, the disinflationary benefits in the United States, has been a rising size of the workforce. And
Immigration.
that's disinflationary. Some people say it's immigration. There's some people who say it's not. I think it is, but that's also a little bit political.
Just a little.
what we know for certain is that the labor force has grown. And that's disinflationary. Is more of that in front of us or behind us? I would say it's behind us.
What about productivity?
Productivity is always, the miracle drug, and that productivity creates Goldilocks. You get disinflationary growth. A lot of that productivity appears to be from bringing on this new workforce and giving them machines to be more productive. So there's we haven't seen the productivity boom yet by any measure of the AI miracle. And that's in front of us without a doubt. How good it'll be, how long it'll take, how much investment needs to be done before we see any productivity based um, improvement. That's all unknown, but also out in front. We're way,
Yeah, and
out.
right, which you can speculate all you want, but to some extent, the Fed and the rest of us have to make decisions based on what's in front of us. So we have a question from J&J. Hi, everybody. If I haven't said hi, great to see you all in the chat. How do you feel about tips? Any view on tips as well as nominal bonds?
Yeah, so tips yields are the 10-year tip is around 1.75% right now. And that's not awful. It's, you're going to maintain your purchasing power relative to CPI. And we can get into whether
Mm.
CPI is right or not, but at least versus that, you'll retain your purchasing power and compound at 1.75 real. It's an okay rate. I'd
There are
load
better. It sounds like you think there are better opportunities.
I'd load the boat at 3%. We have not gotten there before until except for in the 90s. And we got to 2.5, 2.25% in last October. And that's where you load the boat. 1.75, meh, it's
Yeah.
okay.
Yeah. What about
But,
you?
but I will say that it's not okay if the economy does begin to reheat, which I think is occurring.
So you think the economy's strong? It sounds like you think inflation may follow suit.
Um, Well, what I think is that inflation will not go anywhere near the target that will allow the Fed to cut as much as they'd like.
But
Now,
you're not
that
sure
mean
if it'll be
does
strong
that mean
enough
I think
to.
inflation's going to 4%? No, absolutely not. You need a couple of things to happen for inflation to escalate. One is fiscal that is financed with QE. Another is um, supply shocks, which could happen, but that's not, you can't guess that. And the third is labor shortages, tight labor market, where wages have to be raised at a rate higher than the inflation rate
Mm.
and the nominal rate, so that you get this wage price spiral as people pass through that um, wage increase. Now we haven't seen that because supply chains have mostly resolved. The fiscal impulse financed with QE it happened between 2020 and a year later, and it stopped happening, but has had some sort of, follow on sort of reverberations. Um, but it's not happening now. So
Mm.
you'd have to see that to get all those things to get a significantly higher inflation rate. It's a possibility, but that's not what I'd guess. What I'd guess is it just stays, 2.75, 3.25 versus going to either target or 4.
Mm. So in the short term, you think that there's still bonds still have to adjust to the fact that the Fed's not going to be able to cut as much as they've been moving their expectations, but it sounds like you think there's still room for them to actually respond when the Fed admits publicly that they're not going to be able to do as much as they had originally anticipated. But then after that, are you positive
It's
bonds because they look better to stocks relative? Am I understanding the
funny you
timeline?
it's funny you mentioned that. When they tell us they're not going to cut, that's when bonds are going to do great. So you have to buy them before that.
Right.
When they say, you know what, we're going a little fast, we're a little bit worried about inflation coming back, we're going to slow down the pace of cuts, you have to already have been long bonds.
Mhm.
What concerns me about the bond market is they'll be slow to respond to that. And the market will price that for them and continue to sell off bonds. Where do I think bonds should be? I think 3.5 to 3.75 is probably a fair level for the 2 year, given what is in front of us. I think it
Mm.
has to stay higher than that for longer, but let's say that's about right. I think a normal yield curve would put tens at 4.5 and 30s at close to 5. And that's a little bit more room to work. But we made a huge move over the last couple of last month. And given that huge move, and given that there is no macroeconomic data until the meaningful data like the NFP or the next inflation cycle, I think it's likely we're going to chop before we make that next leg higher in yields. Um, and certainly, if the Fed decides to pause in November, that might stop the rise in yields, long-term yields.
Hmm.
It'll hurt the short-term yields, but it'll
Hmm.
might stop the rise in long-term yields.
I know you've been watching the MOVE index as well, so we're going to lean into your sort of many, many years of experience watching bonds and the market. And the MOVE index, just the index that measures volatility in the bond market versus, say, the VIX. What do you think that's why have we? What is that index, or people who are trading that? What is that telling us? Why are you paying attention to it?
Right. So I pay attention to the levels of implied volatility priced into options market across every asset class. And then there's what you can look at, what most people can look at when they think about that. And one of those things is the VIX, the other is the MOVE index. And the MOVE index spiked on October 8th or 9th this week. And people said, this is a big deal. Look at interest rate volatility. And if you look at what I look at, which is what they call the volatility cube of maturity, strike, and tenor of the option, there wasn't really much of a move. The reason why the MOVE index itself moved is because the way it is calculated, it looks at options that are 30 days and under and looks at their implied volatility for 2 year, 5 year, 10 year, and 30 year bonds, adds them up, and prints out a number. And on October 9th, when it spiked, the 30-day option moved across the election.
Yep.
And so, of course, owning options before we get to go to the polls is has a lower implied volatility than the ones that are a day later.
Hmm.
And so I think people are making much ado about nothing. What has happened is long-term volatility and interest rates, but more importantly, when I say long-term, I mean 1 to 3 month volatility. Long-term is years, but 1 to 3 month volatility that's past the election has remained very elevated, expecting something to happen, whether it's geopolitical or the election, cause some very high volatility that we are not realizing today. There was a point where I looked at 10-day vol in realized vol, and it had fallen to like 5%. And VIX index vol, VIX futures vol, is north of 20.
Mm.
So there's something brewing. And the thing that's brewing is an election. What may or may not be brewing is a market reaction to that election, but people are paying up to make sure they're protected in the event something does
Yeah,
happen.
which I think is understandable given the environment we're in. It would make sense when we look across the world. So, two questions as we sort of draw to a close here. I'm going to just squeeze a couple in. Cathal asking, why would a pause of the Fed at the next meeting cause yields on the 10-year to stay bid?
So a pause at the next meeting would most directly affect T-bills and 2 year notes and things of very short maturity, and the yields would tend to rise. It depends on what people expect the path to be, but if they pause, I think that would be significant, and those yields would likely rise. On the other hand, 10-year and 30-year bond yields depend more on whether the Fed is actively looking to cool the economy or actively looking, which they announced they were, to support the economy. If they shift from trying to cool the economy to trying to uh, constrain the economy, that's good for long-term bonds and tends to drive yields down.
because they're going to keep a cap on inflation.
Right.
Yeah, it's that inflation
Oh,
expectation, I think.
and for that matter, they may blow it and cause a recession, which is great for long-term bonds.
But a worry for stocks. So are you it's been one of the things so I think let's finish up with just where you see the best opportunity, but I'm going to throw a comment and then and something that comes up a lot in all of the chats. Ralph asking, are you looking at energy or commodities or any of that? And I think you know that we're in the context of there's a lot of people arguing that, that hard asset camp, that given everything that's going on, that's where the value is. There are also people who are saying the best opportunities are international, which was interesting when I was hearing you talk about how strong the U.S. economy is, and if have a Fed that's kind of willing to make sure that inflation doesn't get out of hand.
Yep.
And then you have also people who are, it's like, I hear everything you're saying, but it's so hard not to invest in stocks because they just keep going up, and every time you try to time that move, especially on the bonds, you've gotten your head handed to you in the last 2 years. So, it's just hard to know what to do. These are the common themes that come up in questions. Where do you see the best opportunity, and how do you think about that debate as you're trying to figure things out?
Well, I think the most important thing I can tell you is that most investors, including myself, should be passively long a diversified portfolio of bonds, hard assets like gold, crypto, if that's your thing, but I would recommend a small allocation relative to your gold allocation, commodities and equities, and bonds and
Yeah.
tips, all of those things. And if you really have a large portfolio that would benefit, you could also diversify into similar things in other countries. But the idea is to be diversified and then sit on it for as long as you can, because it will, over the long term, significantly outperform cash.
Mm.
Now, if you're watching a podcast, chances are you are not an investor who thinks that way. You're an investor who thinks they can beat the market. And my number one piece of advice is you can't beat the market. You think you can, you may have had some good luck, but you're playing against people who are so much better than you, including, and by the way, I say that about myself every morning. I wake up and say, I'm trying to take money from people who are way better, deploying way more resources than I'm able to deploy. And so that's the number one thing. Now, you asked a question. I invest. I try to time markets, and my success has been okay. Does that mean I have alpha? No, I work from the moment I wake up to the moment I go to sleep, 20 every day, to try to maintain whatever edge I have, if any. And I'm constantly trading very small portions of my wealth in that pursuit. I'm not betting everything. Most of my money is in passive beta. Now, you asked the question, so I'll answer it. I think assets are going to underperform cash in the next 3 months. So I happen to be less allocated to beta than I have been in a while.
Mm.
But that means I'm long gold. That means I'm long stocks. That means I'm long tips, bonds, commodities. Always long. But I'm underweight. I also speculate. And my current speculation, which has, if everything goes to hell, every single position fails, I'm going to lose 5% of my AUM. That's it. I'm a conservative investor. I'm trying to make 10% a year, 15% a year in my speculation because I know how hard it is. I'm long 2-year notes via what are called SOFR futures, expecting the Fed to meet the cuts that are currently priced in, not exceed, meet, and that'll do fine. I'm short 10-year bonds, though I've covered some of those. I'm short 30-year bonds, though I've covered some of those, because I expect the yield curve to steepen, whether bear or bull, which means the bonds that I'm short to go down more than the bonds I'm long go down, or vice versa. The bonds I'm long go up more than the bonds I'm short go up. I am long 2% of my AUM in SPX and NASDAQ puts that expire later this year, because I expect there to be some retracement as higher interest rates bite on earnings multiples. Probably happens around the election, after earnings.
Mm.
And now, if one candidate wins, that could change. It really depends on who the candidate is, whether that trade will work or not. So it's small, and I wouldn't be taking a lot of risk ahead of a consequential election. Lastly, energy. I'm long oil. I got long at very attractive levels 2 days ago. The reason I got long oil is because I'm bullish on growth. I think China will probably disappoint in terms of their stimulus, but they've got the ball, and so I think oil will strengthen. And I also think there's some risk that the Israelis will attack the oil infrastructure of Iran. If they do, you get a quick pop and maybe I get out. So that's what I have. What I like is what I have. But what I'm interested in is, once the speculative hype of China comes out of the market, then I think there probably is some reason to get long Chinese stocks, but it's not here. I do like countries other than the United States that are not developed markets, because those stocks are also at all-time highs and are very correlated to US stocks. From a sector standpoint, I don't play that, so I don't have any comments on that. But yes, I'd look to diversify by going outside the US in something not pumped by China, but in emerging markets.
Andy, so many important things, and a lot of people are thanking you for your transparency, but you touched on so many important themes we talk about all the time, and that was understanding the nature of trading, right? If your speculative account versus your sort of longer term account, and being honest about what you're up against, not overconfident, time horizon, all of those really important things that we try to emphasize over and over again. I think you're being overly humble. If you want to know more about Andy's background, check out the link I put in the description. But resource-wise, maybe. Smarts-wise, being outgunned, I'm not so sure we're going to get on board with that. But really appreciate sort of getting that very honest view of what's out there, because as you say, people have a little bit of luck and then they get really confident, and these markets move really quickly. Especially, I'm sure, with all of your experience, I think we're used to some stock volatility. The bond volatility has been very interesting, and it seems like it's more elevated than we've been used to recently, coming out of that zero interest rate environment. People have to be careful about that, don't they?
Yep. And often bonds, bond structures that you can trade can be very levered.
Yeah. Which we know can be dangerous. Andy, it's always super thought-provoking when you come on. Thank you so much for sharing all your expertise. It's a great way to go into the weekend and sort of get ready for what is going to continue to be an action-packed month as we head into this election.
Sure is. Thanks for having me.
Thanks so much. Thanks to all of you. I hope you have a fantastic weekend. Make sure you subscribe if you haven't already, and we'll see you back here on Monday. We're going to have Dale Pinkert with us, trading coach himself. So we'll get some levels. I know you know him as well, Andy. He's always fun. We'll see. Put your song requests in now, people. We can usually squeak a tune out of him when he's on with me. So let's see. Thanks. Have a great one. And as always, everybody, take care and good luck out there.